When it did, we declared that would be a bear trap, meaning it's false. It won't sustain. When it aborted back above that low, it made the low in September. In October, November, was roaring back up and rushed to the highs within a matter of a quarter or two. We issued another buy signal. So entering gold now, if you're a trader, is that you're late, and realize you're late. So your risk is going to be higher.
Welcome to an exclusive conversation with Michael Oliver, a distinguished authority in the world of finance. In this intriguing discussion, we explore Michael's astute observations on recent market dynamics with a keen focus on the precious metals sector, namely gold and silver. With a track record of insightful analysis, Michael provides a seasoned perspective on the timing of market movements and uncovers potential opportunities for traders. Join us for a deep dive into his unique insights as we dissect the current trends and gain valuable insights into the future direction of these crucial markets.
I think the key for gold now, and gold is a leader market. It doesn't wait for events to happen. It anticipates them. After all, it's been around several thousand years. You name me a market that's been around that long, okay? It's held its value for millennia, okay, against government degradation of money. Okay, now, what we have is the topping of the stock market early last year by our metrics. We said, that's it, that the market is making a major top. Now, we did this in year 2000, in January, and the market labored around and even made a marginally new higher high later in 2000 and then collapsed. It did it in 2007. It topped. We knew it was topping in late 2006. We said it was topping in late 2007. And it fell apart by late 2008 with counter-trend rallies. But the stock market was incredibly stupid at each of these highs. It never realized it had been a bubble. This time it's the biggest bubble in U.S. stock market history. They're stupid. They're always lagged to reality. You can go back and look at history of their rate rises and then their rate cuts when they occur, okay? If they go on a rate cut policy now, it's not going to help the stock market. It didn't help in 2007 through 2008. They cut rates like crazy. They cut rates starting in January of 2001 all the way to the bottom. Market still went down. So when they start to cut rates because they get vibes and phone calls, no doubt, behind the scenes from major banks, they're going to get concerned. They're going to plateau. They're going to do the pause, okay? And everybody thinks, well, that's good for the market. No, it's not, because it's acknowledgement by the Fed that something is amiss. The beneficiary of this, again, will be gold, because they'll go back to a policy of monetary excess to defend muni bonds, U.S. government bonds, and the stock market. Unfortunately, a lot of gold bugs and who are depressed all the time now, the last 2-3 years, because it's stalled, which is really the fact. It's not gone down, it's stalled. They don't recognize that gold is not directly correlated to the direction of interest rates in the stock market. They seem to think that if the stock market goes down, oh, that means, quote, deflation, and it means gold will go down. And if rates stay high, gold's going to go down. Well, throughout history, this is not true. It's always an important thing to get in at the right point on a long-term trade. Our entry point for gold, after being bearish from 2012 through 2015, was a couple months off the low in February of 2016 at $1,140. That was our primary buy for our subscribers. We had a secondary buy after that 2012 flopping around action. No, excuse me, 2018. We'd had a recovery off the 2015 low, then we waffled, and gold went back down into the lower 1200s. Actually, the upper 1100s. And when it came up out of there, we issued a second major buy. When the gold market went down through the lows of the range of 2020 through 2022, the low end was 1675. There was a clear floor. It broke that last summer. When it did, we declared that would be a bear trap, meaning it's false. It won't sustain. When it aborted back above that low, it made the low in September. In October, November, was roaring back up and rushed to the highs within a matter of a quarter or two. We issued another buy signal. So entering gold now, if you're a trader, is that you're late, and realize you're late. So your risk is going to be higher. But if I had to say right now, if you're not in it and you suddenly want to get into gold, then the pullback that we've had, a very protracted multi-month pullback, mostly redundant, up, down, up, down, up, down. The other day, we made a marginal lower low than we did in June. We actually nipped under 1900. Didn't bother me. Bothered a lot of folks. We think that the time spent on the downside is now near exhaustion on the clock. And there's certain measurements we have for defining the clock. You get much of an uptick here, like even, back over 1950 again. I would write it off. It's over. We're going back up again. There's going to be a rush. Silver has a level. Now, its rally this year got up above $26. Remember, its low was near 17 last September. It rushed up to over 26. Right now, we're trading either side of 23 today. I think we traded over 23 at one point today. You get back over 25 again, assume white knuckle flight is about to begin, that we're going to rush again. So I would say get gold above 1950 if you're waiting for some level of confidence to enter, and silver back over 25. Not the highs of the year, which were above 26, but get back over 25 again. And at that point, I would assume if you're not in, you better be in. And I think the temper and tone of those markets, gold, silver, and the miners, which are definitely a languished, lagging sector to gold, they always underperform on the downside. And there's points in bull trends where they vastly outperform, and which we expect this time. If silver gets back over 25 and gold over 1150, I think I would focus at that point on miners and silver. Gold's the mama, but I think I would focus on silver and the miners for better percent performance. And I think it's probably something you start to see an upturn soon. I think the long bond market, we turned bearish in October of 2020. Now, you look at a price chart, and TLT and T-bonds were way up there, way up there. They effectively crashed. The decline in price, the rise in yields that bonds produced, I'm talking long-term end of the bond market, the 30-year bonds, 20-year, that kind of stuff, not the short-term, was of the dimension of the S&P, let's say, and crashing down back down to its lows around 1,000. Had S&P done that in 2022 from its highs, upper 4,000, dropped down to about 1,000. That's what T-bonds did effectively in price. They went back to the price lows of 2009, meaning the yield levels. Okay. Then they had a rebound from the October low last year. They had a rebound. Sharp, lasted several months. But then they rolled back over again recently, and now they're testing that price low or the yield high. In fact, I understand on some actually daily closing yields of 10-year on out, we actually maybe nipped new high yields the other day versus the October highs. So we're now playing around at the highest yields we saw late last year, or the lowest prices. We don't think it's going to sustain. We think the bonds are going to turn back up, meaning yields are going to start to drop, not because everything's rosy, but because the central bank starts to panic. And because I think once there's a perception among asset managers that, the stock market rally is starting to roll over, they're going to seek some area of relative safety. And frankly, technically speaking, the bonds look like they'll be safe for a rally here.
As we conclude our conversation with Michael Oliver, we're left with a wealth of knowledge and strategic insights into the world of financial markets, particularly in the realms of gold and silver. His unique perspective, honed over years of experience, offers traders and investors a valuable compass in navigating these dynamic markets. We hope you found this discussion as illuminating as we did. For more expert analyses and timely updates on the ever-evolving world of finance, be sure to subscribe to our channel and stay tuned for future conversations with industry leaders. Remember, knowledge is your most potent asset in the world of trading and investing. Thank you for joining us, and until next time, may your investments be as prosperous as your wisdom is vast.